For more on this market, now let's bring in Mohammed El-Erian, Allianz's chief economic advisor. Mohammed, here's my probably biggest question about the overall economy as we head into the second half. It looks like consumers are still spending, but they've been spending down their savings. Inflation remains stubbornly high. The essentials cost more, and the cost of borrowing is certain to rise. So is there the risk of this consumer vice where consumers could slam the brakes more quickly than historically?
Thanks, John, for having me. Yes, absolutely, there's the risk. You left out three additional things. The Fed is hiking aggressively into a slowing economy. The fiscal impetus is now negative, and exports aren't doing too well. So you have these various components all coming together and slowing our economy much faster than we'd like it.
Does the Fed have any choice, though?
No, it doesn't. It was late, and it fell into the worst trap, which is you have to play catch up, but your window for hiking rates in an orderly fashion has closed. So rather than helping the economy soft land, the Fed now risks actually contributing to a hard landing, and that's of its own making because it is so late.
Right. So let's look at the Delivering Alpha stock survey. We asked 500 money managers about how the Fed has been doing. 55% said the Fed is rightly getting more aggressive in fighting inflation. You just said they don't really have any choice, but it sure would have been nice if they had started fighting it earlier. What do you put as the odds that the Fed is going to end up with a hard landing because of the corner they sort of painted themselves into?
Unfortunately, John, it's a very high probability. The Fed is a good year late. So when you are so late, you're going to have no choice but to hike aggressively. And let's not forget that it also has to reestablish its damaged credibility. So I'm afraid that it's a high probability, it's uncomfortably high, and it's worrisomely high.
Now, that's different from what a lot of people have been saying that I've been hearing and I've been asking this week, saying, oh, well, a recession isn't the base case scenario, and here are all the ways a soft landing could happen. Various CEOs have been saying this. It seems like nobody wants to say what you're saying, but does that mean that the scenario you're laying out is not priced in as far as what you say is likely to happen in the second half, or a lot of people in denial?
So as Mike said, we've started to price it in. You know, the first driver of the sell-off was all about interest rate risk, about the fact that the Fed was behind, it was going to have to hike, and the market was pushing the Fed to hike. And the market got carried away in terms of pricing in quite a few hikes. That was phase one of the sell-off. In phase two, recession fears started creeping in. And that is what's driving the market right now. It is much less inflation fears. It is now the mix of a recession fear and also the realization that the probability of a Fed policy error is very high.
Okay, so how then should investors think about the second half of this year and the signposts they should look for to see whether that worst case scenario is panning out? In my mind, I've been imagining, hey, when consumers get back from these vacations that they're determined to take because, darn it, we deserve it after COVID, the credit card bills come in and maybe they go, wait a minute, we got to tighten up. Is that an important potential moment, and how does that show up in the data, if at all?
It is a potential moment, and we're already picking up a declining saving rates, and we're already picking up declining cash, readily available cash to pay bills. A latest survey by the Wall Street Journal shows that that's now down to 50% of people who feel that they have readily available cash for big bills. So we are picking that up. Look, John, the hope is that somehow we will get something on the supply side that will help us. I don't think we can rely on the demand side. We need some good news on the supply side. Now, there is some good news. You know, today alone, the commodity index is down 3%. We just have to stop inflation broadening and destabilizing inflation expectations.
And we need more wealthy consumers to keep spending, I imagine, because we know that the working class, the poor, with all of these must-haves like gasoline getting more expensive, have less to spend on durable goods, right?
Yeah, and you touched on a really important point, which is why I've been so upset that the Fed hadn't moved earlier. The sort of outlook that we're looking at right now is going to be another great unequalizer. It's going to hit the low-income segments of our populations particularly hard, and they already have used up a lot of resilience. So there's also a really important social aspect to it, John.
Yeah, important downside scenario that we're looking very seriously at, that investors and everybody else should consider. Mohammed, thank you.
Thank you, John.
El-Erian.